There is a ghost in the machine of the market, a silent, invisible force that ensures the vast majority of people who attempt to build wealth within it will fail. It isn't a conspiracy of Wall Street bankers or a flaw in the code of the economy. It's a flaw in the code of our own minds. We are hardwired with instincts that served our ancestors well on the savannah, but which are catastrophically wrong in the world of finance. We are designed to follow the herd, to react instantly to perceived threats, to be overconfident in our own limited knowledge, and to chase the exciting, shimmering mirage on the horizon. And so, most investors are doomed to fail. They spend their entire lives searching for the secret to winning, the one magic formula, the hidden key to unlocking market riches. They ask, how can I be brilliant? How can I find the next Amazon? How can I time the market perfectly? And this very line of questioning is the key to their own destruction. But a handful of individuals, operating from a quiet office in Omaha, Nebraska, discovered a profound truth. They realized that the path to extraordinary success was not paved with moments of sheer brilliance, but with the diligent, systematic avoidance of stupidity. The most powerful secret in investing, the one that truly guarantees long-term success, is not about finding the right answers, it's about asking the right questions. And the most powerful question is a backward one. Instead of asking how to win, they asked, how could we guarantee that we lose everything? What are all the ways we could fail? They made a comprehensive list of every foolish, impulsive, and irrational thing an investor could do. And then, they simply, methodically, and ruthlessly avoided doing them. This mental model, a simple flip of perspective known as inversion, is the master key. It is the framework that turns our flawed human psychology from a liability into an asset. It is the intellectual scaffolding upon which the entire Berkshire Hathaway empire was built. And for you, it is the beginning of a financial transformation. By the end of our time together, you will no longer see the market as a place to prove your genius. You will see it as a minefield of common errors. And you will be equipped with the map to sidestep every single one, clearing the path for a rational, patient, and massively profitable journey toward true financial freedom. Our journey begins with the bedrock principle, the very foundation of this entire philosophy. It's a concept so simple it sounds almost insulting, yet so profound that it separates the enduringly wealthy from the temporarily lucky. It is the conscious decision to prioritize the avoidance of stupidity over the pursuit of brilliance. For most people, this is a radical and uncomfortable idea. Our entire culture, from our education system to our corporate ladders, celebrates the flash of genius, the brilliant insight, the complex solution that no one else could see. We are taught to solve problems by adding complexity, by searching for that one clever trick. But the masters of the investing universe, Warren Buffett and his partner Charlie Munger, built their fortunes on the opposite premise. They understood that in a complex system like the global economy, where countless variables are in motion, attempting to be consistently brilliant is a fool's game. There are too many ways to be wrong. However, there are a finite and identifiable number of ways to be truly catastrophically stupid. And if you can identify and avoid those, you win by default. This entire mental framework was most famously articulated not by Buffett but by the intellectual powerhouse at his side, Charlie Munger. Munger, a man whose mind operates like a latticework of mental models drawn from every discipline imaginable, was deeply influenced by a 19th-century German mathematician named Carl Jacobi. Jacobi was known for solving difficult problems by following a simple mantra: invert, always invert. If he was stuck on a complex mathematical proof, he wouldn't just push forward, he would flip the problem on its head. He'd ask, what if I try to prove the opposite? This backward approach would often reveal a hidden pathway to the solution that was invisible from the forward-looking perspective. Munger took this mathematical tool and applied it to the messy, emotional world of business and investing. He reasoned that if he wanted to help Berkshire Hathaway succeed, the first and most important step was to figure out everything that could possibly make it fail. Let's travel back to the early 1960s, to a much smaller, more nascent Berkshire Hathaway. Buffett and Munger were not yet the global icons they are today. They were sharp, ambitious money managers, but they were still defining their core philosophy. One of their pivotal experiences came with a company called Dempster Mill Manufacturing. It was a classic cigar butt investment for the young Buffett, a terrible business that was trading for a ridiculously cheap price. Dempster made windmills and farm implements, a business in terminal decline. The company was barely profitable, bleeding cash, and going nowhere fast. Buffett bought a controlling stake for a price that was well below the company's working capital, meaning he was essentially buying the assets for free. The typical investor, the genius investor, would have come in with a grand, brilliant plan to turn the company around. They would have developed a new marketing strategy, invested in new product lines, and tried to engineer a miraculous comeback in a dying industry. This is the path of seeking brilliance. Buffett and Munger, guided by the nascent principle of inversion, did the opposite. They inverted the problem. Instead of asking, how do we make this a great business, they asked, what is currently being done here that is monumentally stupid and destroying the remaining value of this company? The answer was immediately obvious. The previous management was plowing every meager dollar of profit back into the failing windmill business, buying more inventory that wouldn't sell, and maintaining unnecessary operations. It was a capital allocation nightmare. The stupidity was continuing to pour good money after bad. So their solution wasn't a brilliant new product. It was to stop the stupidity. They installed a new, ruthless manager named Harry Bottle. His entire mandate was not to grow the business, but to stop the bleeding. He slashed unnecessary inventory, sold off unproductive assets, and generated a huge pile of cash from the company's liquidation value. That cash, which would have been destroyed by reinvesting it in the failing windmill business, was instead sent back to Berkshire Hathaway's headquarters in Omaha. Buffett then took that capital and deployed it into far better businesses and investments. He didn't fix Dempster Mill, he stopped the ongoing failure and harvested the capital. He avoided the stupid decision of reinvesting in a terrible business, and in doing so, created the fuel for his future, brilliant decisions. This foundational anecdote reveals the raw power of inversion. It's not about having all the answers, it's about recognizing and eliminating the obvious mistakes. Success wasn't found in a brilliant strategic plan, it was found in a simple do-not-do list. The reason this backward-thinking approach is so profoundly effective lies deep within the architecture of our brains. At a fundamental level, our minds are not wired for the modern financial world. We are running on ancient software. One of the most powerful and well-documented glitches in that software is a cognitive bias known as loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky demonstrated that for the average human being, the psychological pain of losing a dollar is roughly twice as powerful as the pleasure of gaining a dollar. Think about that. A 50% loss feels twice as bad as a 50% gain feels good. This creates a massive emotional asymmetry in how we approach risk and reward. Our instinct, our deepest, most primal drive, is not necessarily to seek gains, but to desperately avoid the gut-wrenching pain of a loss. The typical investment strategy, which is all about finding the next big winner and chasing returns, runs directly counter to this fundamental psychological wiring. It creates a constant state of internal conflict, pushing investors to take foolish risks in the hope of a big gain, only to be paralyzed by fear and sell at the absolute worst moment when faced with the acute pain of a loss. Inversion hacks this system. It aligns your investment strategy with your own psychological reality by making the primary goal the avoidance of catastrophic error, the avoidance of the big loss. You are working with your brain's natural loss aversion tendency, not against it. The mantra ceases to be, how do I get rich, and becomes, how do I guarantee I don't go broke? This simple shift dramatically lowers the emotional stakes. It transforms investing from a high-stakes casino game into a methodical process of risk management and error elimination. Furthermore, inversion is a powerful antidote to another pervasive cognitive bias, the Dunning-Kruger effect. This is the tendency for people with low ability in a specific domain to overestimate their own competence. In investing, this is rampant. A beginner who gets lucky on a few trades starts to believe they have a special gift for stock picking. They mistake luck for skill and develop a dangerous overconfidence. They believe they are, or can be, brilliant. Inversion forces a degree of intellectual humility. The very act of starting with the question, "How can I fail?" presupposes that failure is a real and constant possibility. It forces you to confront the limits of your own knowledge. It makes you acknowledge that you cannot predict the future, that you don't know which new technology will succeed, and that you are not smarter than the collective market. Instead of relying on your own supposed brilliance, you rely on a system designed to protect you from your own inevitable blind spots and biases. It is a framework built not for geniuses but for intelligent people who know they are not geniuses, which, ironically, is the first step toward true investment wisdom. So how do you translate this powerful psychological principle into a concrete, actionable blueprint for your own financial life? How do you build an investment strategy around this idea of avoiding stupidity? It's a four-step process. First, you must clearly and specifically define your goal. Let's say your goal is to achieve long-term portfolio growth that outpaces inflation and allows for a comfortable retirement. That's a good, solid objective. The second step is the critical one. Invert it. You must now define with brutal honesty what absolute failure would look like. Failure isn't just not meeting the goal. Failure is its catastrophic opposite. So the inverted goal becomes to suffer a permanent loss of capital, to have my portfolio decimated by a market crash, to churn my account to death with fees and taxes, and to end up with less money in real terms than I started with. You need to paint a vivid picture of the disaster you are trying to avoid. The third step is the most creative and crucial part of the process. You must now brainstorm every single pathway that leads to that defined failure. Get a piece of paper or open a document and list every conceivable stupid thing an investor could do. What would you do if your explicit goal was to destroy your wealth? Your list might include things like borrowing a lot of money to invest, using excessive leverage, buying stocks in companies I don't understand based on a hot tip, putting all my money into one single speculative investment, trading in and out of the market every day based on news headlines, selling everything in a panic when the market drops, ignoring valuation and paying any price for a popular stock, investing with managers who have a history of fraud, and failing to diversify. This list is your anti-master plan. It is a detailed recipe for financial ruin. This is the core work of inversion. You are building a map of all the landmines in the field before you even take your first step. For entrepreneurs and those with a CEO mindset, this is an invaluable exercise not just in investing, but in business strategy, identifying all the ways a project or a company could fail before launch. The fourth and final step is to build your rulebook. You take your comprehensive list of failure modes and, for each one, you create a simple, unbreakable rule designed to prevent it. If using excessive leverage is on your list of stupid things, your rule becomes, "I will never invest with borrowed money." If buying companies I don't understand is on the list, your rule becomes, "I will only invest in businesses whose products and business models I can explain simply to a child." If selling in a panic is on the list, your rule becomes, "I will not sell any stock during a market decline of more than 20% unless the fundamental story of the business has deteriorated." This set of rules becomes your personal investment constitution. It is the system that protects you from your own worst emotional impulses. It is your pre-commitment to rational behavior. Your focus is no longer on finding the next great idea, but on rigorously adhering to your system of avoiding bad ones. This is how you build a fortress around your wealth, a fortress designed not to attack the market for brilliant gains, but to defend your capital from the relentless assaults of your own human nature. To truly appreciate the wisdom of this approach, we must shine a bright light on its opposite, the path that 99% of investors follow. This is the path of the genius investor, the individual who, consciously or subconsciously, believes they are smarter, quicker, or have better information than everyone else. Their entire strategy is predicated on the pursuit of brilliance. They are not trying to avoid mistakes. They are trying to make spectacular, world-beating moves. This path is seductive. exciting, and almost always leads to ruin. The archetypal example of this folly is the story of long-term capital management, or LTCM. In the mid-1990s, LTCM was the hedge fund equivalent of the 1927 Yankees. Its boardroom was a pantheon of financial gods. It was founded by John Meriwether, the legendary bond trader from Salomon Brothers, and its partners included two Nobel Prize-winning economists, Robert Merton and Myron Scholes, whose work on options pricing formed the very mathematical foundation of modern financial theory. These were not just smart people, they were, by any objective measure, certified geniuses. Their investment strategy was the epitome of seeking brilliance. It was based on incredibly complex arbitrage models that sought to exploit tiny, fleeting pricing discrepancies in global bond markets. They built algorithms that required supercomputers to run, models so arcane that only a handful of people on the planet could truly understand them. And for a few years, it worked spectacularly. They generated returns of over 40% annually, and the world's largest financial institutions lined up to give them billions of dollars to manage. They were the smartest guys in the room, and they knew it. But their entire system was built on a foundation of hubris. They believed their brilliant models had eliminated risk. They failed to invert the problem. They never seriously asked the question, what series of events, however improbable, could cause our supposedly perfect models to fail and wipe us out completely? Because they didn't ask the question, they didn't see the answer coming. They used staggering amounts of leverage, borrowing over $100 billion against just $4 billion of their own capital. Their models assumed that global markets would behave within certain statistical norms and that correlations between different assets would remain stable. In 1998, when Russia defaulted on its debt and a subsequent flight to safety occurred in global markets, their models broke. Correlations they thought were stable went haywire. Events they believed were statistically impossible happened day after day. Their supposedly risk-free trades turned into a black hole of losses. In a matter of weeks, the fund lost over $4.5 billion and was on the brink of a collapse so catastrophic that the Federal Reserve had to orchestrate a massive bailout from 14 major banks to prevent it from taking down the entire global financial system. The smartest men in the room, the Nobel laureates, the legends of Wall Street, had committed one of the oldest and simplest forms of investment stupidity. They took on more risk than they could handle and were wiped out by an event they hadn't foreseen. They were so focused on being brilliant that they forgot to protect themselves from being wrong. This is the path of the 99%, played out on a grand scale. It's the same impulse that drives the amateur investor to put their life savings into a speculative biotech stock or a volatile cryptocurrency, believing they have found the one brilliant idea that will make them rich. It is a siren song that has lured countless ships to their doom. And it all starts with the failure to ask that one simple backward question, how can I lose? The financial impact of adopting an inversion-based mindset is not theoretical. It is concrete, quantifiable, and it manifests directly in the long-term performance of your investment portfolio. The most direct connection is the mitigation of catastrophic loss. Consider the brutal mathematics of losing money. If your portfolio drops by 50%, you have not lost 50% of your wealth. You have lost the ability to compound on that capital forever. And to get back to where you started, you don't need a 50% gain. You need a 100% gain. A single massive loss sets you back years, if not decades. An investment strategy built on avoiding stupidity is, first and foremost, a strategy for avoiding that devastating 50% drawdown. By filtering out businesses with excessive debt, unproven models, or dishonest management, you systematically eliminate the investments that are most likely to go to zero. This dramatically raises the floor of your potential outcomes. While the genius investor might have a portfolio that generates a 100% return one year and a 70% loss the next, the inversion-minded investor aims for a steady, reliable compounding that is never interrupted by a portfolio-crushing blow. This principle has a massive impact on wealth management and overall portfolio growth. Reliable compounding is the most powerful force in the universe, but it only works if it is left uninterrupted. By focusing on not losing, you ensure the compounding machine is always running. This translates to lower volatility in your portfolio. Lower volatility isn't just a comfort, it's a financial advantage. It prevents you from making the biggest behavioral mistake of all, selling at the bottom. When your portfolio is built on a foundation of durable, well-understood businesses, you are far less likely to panic during a market crash, because you have already inverted the problem and understand the difference between a temporary price fluctuation and a permanent impairment of business value. This leads to a lower portfolio turnover rate. You trade less, which means you pay far less in commissions, fees, and, most importantly, taxes. The constant drag of frictional costs is a silent killer of returns for the hyperactive investor. The inversion investor, who acts rarely and with great conviction, keeps more of their money working for them. Over a lifetime of investing, this seemingly small advantage in cost savings compounds into a staggering difference in final wealth. The direct financial connection is this: avoiding stupidity is mathematically superior to chasing brilliance. It creates a smoother, more reliable, and ultimately higher return path by preserving capital, minimizing costs, and allowing the miracle of long-term compounding to work its magic undisturbed. The second great pillar of this inverted philosophy directly attacks one of the most seductive and destructive temptations in all of finance: the urge to time the market. Almost every investor at some point has felt this pull. They look at a chart of the S&P 500, see the dizzying peaks and terrifying troughs, and a little voice in their head whispers, "If only I could sell at the top and buy back at the bottom, I'd be rich." This desire to be a market prophet, to predict the short-term gyrations of the economy, is perhaps the single greatest destroyer of wealth for the average person. The conventional approach is to ask, when is the right time to buy? Is the market too high? Is a crash coming? They consume endless forecasts from market gurus, analyze technical charts, and try to decipher the cryptic pronouncements of the Federal Reserve. It is an exhausting and utterly futile exercise in seeking brilliance. The inversion practitioner, however, asks a different, far more useful question. What actions, driven by an attempt to time the market, would absolutely guarantee the destruction of my long-term returns? By inverting the problem, the folly of the entire enterprise becomes crystal clear. No single event better illustrates Warren Buffett's mastery of this inverted principle than his actions during the darkest days of the 2008 financial crisis. As the autumn of 2008 unfolded, the global financial system was careening towards total collapse. Lehman Brothers had just declared bankruptcy, AIG was on government life support, and the stock market was in a state of freefall. Fear was not just in the air, it was the air. The overwhelming sentiment, from Wall Street professionals to Main Street retirees, was to sell everything, hoard cash, and wait for the storm to pass. The question on everyone's lips was, how much lower can it go? Where is the bottom? They were trying to time the point of maximum pessimism. On October 16, 2008, with the market having already plunged more than 40% from its peak, Warren Buffett penned an op-ed for the New York Times titled, "Buy American, I Am." In this article, he did not claim to be a prophet. He explicitly stated, "I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now." He was not seeking the brilliance of calling the exact bottom. Instead, he inverted the problem. He asked himself, what is the guaranteed cost of waiting for certainty and good news before investing? His answer was simple and profound. He wrote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful. Bad news is an investor's best friend. It lets you buy a slice of America's future at a bargain price." He understood that if you wait until the economy is recovering and the headlines are positive, you will have missed the entire opportunity. The great bargains only exist when fear is rampant. He wasn't trying to time the bottom to the day or week. He was timing the emotion. He recognized that the price of waiting for the fear to subside would be a massively higher entry point for his investments. So while the rest of the world was asking, when should we buy, Buffett was acting on the answer to a different question: what is the catastrophic mistake we could make right now? And the answer was being paralyzed by fear and staying on the sidelines. He invested billions of dollars into companies like Goldman Sachs and General Electric during this period. He didn't catch the absolute bottom. The market continued to fall for several more months, but his long-term returns on those investments were astronomical. He won not by being a perfect market timer, but by avoiding the stupid, emotionally driven mistake of panicking with the herd. The psychological trap that makes market timing so irresistible is a powerful cocktail of cognitive biases. The most prominent is hindsight bias. When we look at a historical stock chart, the peaks and valleys appear obvious, almost preordained. It's easy to look back at the dot-com bubble crash of 2000 or the meltdown of 2008 and think, of course, the top was in. The signs were all there. I would have sold. This illusion of past predictability creates a dangerous overconfidence in our ability to predict the future. We believe that because the past looks so clear in the rearview mirror, we can surely navigate the road ahead. But the future is never clear. It is a fog of uncertainty, and the signals that seem so obvious in hindsight are always buried in an avalanche of contradictory noise in the present moment. This overconfidence is supercharged by the herd mentality, one of the most powerful forces in human psychology. As social creatures, we are wired to find safety in numbers. When everyone around us is panicking and selling, our deepest instincts scream at us to do the same. It feels physically dangerous to be buying when the herd is stampeding for the exits. Conversely, when everyone is euphoric, talking about their easy gains in a bull market, the fear of missing out, or FOMO, becomes overwhelming. It feels safe and smart to buy when prices are high and rising, because everyone else is doing it. This instinct is what causes the average investor to consistently buy high and sell low. They are acting not on rational analysis, but on social contagion. The market timer believes they are a detached, rational observer, but more often than not, they are simply a puppet of the crowd's emotions. They feel brilliant when they sell and the market drops another 2%, but they are too terrified to buy back in. Then, when the market rebounds sharply, they are left behind, waiting for another perfect entry point that never arrives. The attempt to time the market is, in reality, an attempt to outsmart our own deepest psychological programming, a battle that very few people are equipped to win. So how do we build a practical, systematic defense against this destructive urge? We must create a blueprint that removes the decision of when to invest from our hands altogether. The first step, as always, is to invert the core question. Stop asking when is the best time to invest and start asking what actions would guarantee that I miss the market's best days and lock in poor returns. The answer is clear: trying to jump in and out of the market. The data is unequivocal on this point. Studies have repeatedly shown that a huge portion of the stock market's long-term gains come from just a handful of explosive days. Missing just the 10 best days in the market over a 20-year period can cut your total return by more than half. The cost of being on the sidelines is not just missing out on a little upside, it is potentially catastrophic to your entire financial plan. The goal, therefore, is not to catch the best days, but to create a system that ensures you are invested nigh to during the best days whenever they may occur. The second step is to implement a rule-based investment strategy that automates your buying and removes emotion from the equation. The most effective tool for this is dollar-cost averaging. This simply means investing a fixed amount of money at regular intervals, say $500 on the first of every month, regardless of what the market is doing. When the market is high, your fixed dollar amount buys fewer shares. When the market is low and fear is rampant, that same fixed dollar amount automatically buys more shares. It forces you to be greedy when others are fearful and a little more cautious when others are greedy, all without requiring any forecasting or emotional fortitude on your part. It is an automated system for avoiding the stupid decision to stop investing when prices are low. For larger lump sums of cash, You can set predefined buying criteria based on objective valuation metrics, not on market sentiment. For example, you might create a rule to deploy a certain percentage of your cash whenever the overall market's price-to-earnings ratio drops below its historical average. The key is to make the decision before the moment of panic or euphoria arrives. You are creating a pre-commitment to rational behavior, a system that functions as the adult in the room when your emotional brain wants to take over. This is the essence of a sound investment strategy. It is a system designed not to achieve perfection, but to prevent self-sabotage. The antithesis to this systematic, humble approach is the tragic figure of the market timer. This individual represents the 99% who believe they can outwit the market's chaotic dance. Their life is a whirlwind of anxiety and second-guessing. They begin their day not with a coffee and a newspaper, but with a frantic check of pre-market futures. Their computer screen is a dizzying mosaic of charts with trend lines, moving averages, and obscure technical indicators. They are glued to financial news channels, listening breathlessly as pundits offer contradictory predictions about the market's next move. This person lives in a state of perpetual almost. They almost bought at the bottom in 2009, but they were waiting for one more confirmation signal. They almost sold at the peak in 2021, but they got greedy and held on for a little more upside. Their portfolio is a testament to their frantic activity. They might sell a solid long-term holding after a 10% drop, hoping to buy it back 5% lower. But then the stock unexpectedly rallies, and they are left behind, watching from the sidelines as it climbs 20% without them. Frustrated, they chase a hot momentum stock that everyone is talking about, buying in near the top just as the early investors are cashing out. They are constantly whipsawed by volatility, selling on bad news and buying on good news, the exact opposite of a profitable strategy. They see themselves as a nimble, sophisticated trader, but in reality they are a leaf in the wind, completely at the mercy of market sentiment. Their constant trading racks up a fortune in transaction costs, bid-ask spreads, and, most punishingly, short-term capital gains taxes. They are engaged in a full-time, high-stress activity that, for the vast majority of people who attempt it, produces results that are significantly worse than if they had simply bought a low-cost index fund and done absolutely nothing. The path of the market timer is a perfect illustration of how the pursuit of brilliance, in this case, the brilliant feat of predicting the market's next move, is a guaranteed path to mediocrity or worse. The direct financial connection between inverting the market timing problem and your net worth is stark and easily quantifiable. The most significant impact is the capture of the market's equity risk premium. The stock market provides higher long-term returns than safer assets like bonds or cash, precisely because it is volatile and unpredictable. This higher return is your compensation for bearing that risk. The market timer, by trying to avoid the downturns, systematically exits the market during periods of high volatility. In doing so, they often miss the explosive, unpredictable rallies that follow these downturns, which is where a huge portion of the equity risk premium is actually earned. By staying invested through the full cycle, the buy-and-hold investor guarantees they will capture the market's full long-term return. Let's put some numbers on this. A famous study by Fidelity charted the performance of the S&P 500 over a 40-year period. A hypothetical $10,000 investment left untouched would have grown to over $1 million. However, if an investor had tried to time the market and missed just the 10 best trading days in that entire 40-year span, that's 10 days out of more than 10,000, their final return would have been cut in half. If they had missed the 50 best days, their return would have been 93% lower, barely beating inflation. The financial cost of being on the sidelines is not a small rounding error. It is the difference between achieving financial freedom and treading water for your entire life. Furthermore, this approach drastically improves your tax efficiency, a cornerstone of effective wealth management. Every time a market timer sells a position they've held for less than a year, any gain is taxed at their ordinary income tax rate, which can be as high as 37%. By contrast, the long-term investor who holds for more than a year pays the much lower long-term capital gains tax rate. This tax differential alone can add tens of thousands or even hundreds of thousands of dollars to your net worth over an investing lifetime. By inverting the problem, you transform your goal from the impossible task of predicting the future to the achievable task of remaining invested. This simple shift in perspective is one of the most powerful levers you can pull to accelerate your portfolio growth and ensure your long-term success. Our third pillar of inversion tackles the very heart of the investment process, the selection of individual assets. For many, this is the most exciting part of investing. It's the treasure hunt, the search for the next Apple, Google, or Tesla. The conventional question that drives this search is, what stock is going to be the next big thing? What company has a revolutionary new technology or a visionary CEO that will change the world? This forward-looking quest for the brilliant, undiscovered gem is what fuels the entire speculative mania of the market. It's a compelling narrative, but it's also a deeply flawed and dangerous investment strategy. The inverted approach, once again, flips this entire paradigm on its head. It dismisses the question of finding the next big winner and instead asks a far more practical and powerful question. What are the common characteristics of businesses that consistently destroy investor capital, and how can I systematically avoid them? This isn't a treasure hunt, it's a process of elimination. It's about recognizing that you don't need to find the one-in-a-million success story if you can simply avoid the thousands of easily identifiable failures. There is no more powerful case study for this principle than Warren Buffett's conduct during the great dot-com bubble of the late 1990s. It was a period of wild, irrational exuberance. Any company with a .com in its name, regardless of its business model or lack of profits, saw its stock price soar to astronomical heights. Companies that had never earned a dime of profit were being valued in the billions of dollars. The narrative was intoxicating. The internet was a new paradigm, and old metrics like earnings and cash flow were obsolete. In this environment, Warren Buffett and Berkshire Hathaway became figures of ridicule. They were openly mocked in the financial press as old-fashioned dinosaurs who didn't get it. Barron's famously ran a cover story in 1999 titled, "What's Wrong, Warren?" questioning if the legendary investor had lost his touch, as Berkshire's stock badly trailed the performance of the high-flying NASDAQ index. The pressure to join the party, to prove he still had it, must have been immense. But Buffett was not playing the game of seeking brilliance. He was not trying to predict which of the thousands of new internet startups would become the next Microsoft. He was rigorously applying his inverted stock-picking philosophy. He was asking, what are the characteristics of businesses where I am most likely to suffer a permanent loss of capital? His checklist for failure was clear. First, businesses he could not understand. He famously said he wouldn't invest in technology companies because he had no idea what they would look like in 10 years. He couldn't confidently assess their long-term competitive advantages. Second, businesses with no history of consistent profitability. These dot-com companies were burning through cash with no clear path to ever making money. They were stories, not businesses. Third, businesses trading at astronomical valuations completely disconnected from their underlying economic reality. Paying 100 times revenue for a profitless company was, in his view, a form of speculation, not investment, so he simply avoided the entire sector. He put all of these companies into what he and Munger call their too-hard pile. He wasn't making a prediction that the bubble would burst. He was making a simple statement of personal risk management. He was avoiding stupidity. When the bubble inevitably imploded in 2000 and 2001, and the NASDAQ Composite Index lost nearly 80% of its value, wiping out trillions of dollars of investor wealth, Berkshire Hathaway stood by, its capital intact, ready to deploy into the wreckage at bargain prices. His performance during that period wasn't the result of a brilliant call on the crash. It was the result of a disciplined, systematic refusal to participate in an activity that violated his core principles of avoiding businesses he didn't understand and couldn't value. The psychology behind our attraction to hot stocks is deeply rooted in some of our most powerful cognitive biases. Chief among them is the narrative fallacy, a term coined by Nassim Nicholas Taleb. Our brains are story processing machines. We are far more persuaded by a compelling story than by a dry set of data. A story about a visionary CEO who is going to cure cancer with a new biotech drug is infinitely more exciting and memorable than a spreadsheet showing a company's stable but modest free cash flow growth. We fall in love with the narrative and ignore the overwhelming odds of failure for a pre-revenue biotech firm. This is compounded by recency bias, our tendency to extrapolate recent trends indefinitely into the future. If a stock has gone up 500% in the last year, our brain intuitively assumes it will continue on that trajectory, ignoring the concept of valuation or regression to the mean. We see the recent past and mistake it for a glimpse of the future. This entire psychological cocktail is lit on fire by the powerful emotion of FOMO, the fear of missing out. When we hear stories of friends, neighbors, or anonymous people on the internet making easy money on a particular stock, it triggers a deep-seated social anxiety. We feel like we are being left behind, that we are missing out on the one big opportunity to change our lives. This emotional pressure overrides our rational judgment, causing us to abandon our investment strategy and chase after the hot trend, often buying in at the peak of the mania, just as the early smarter money is quietly heading for the exits. The inverted approach to stock picking is a direct antidote to these biases. By starting with a checklist of what to avoid, you force yourself to engage your rational, analytical brain before your emotional, story-driven brain can get hijacked. It replaces the question, "Is this an exciting story?" with the question, "Does this business have any of the clear markers of a future failure?" It is a system designed to impose logic on a process that is, for most people, driven entirely by emotion and narrative. So how do you build your own blueprint for avoiding bad investments? The central tool is the creation of what Charlie Munger calls a too hard pile. Your primary job as an investor is not to find reasons to buy a stock, it's to find reasons to say no and throw it in the too hard pile, moving on to the next idea. The first step is to create your own failure checklist. This is a list of objective criteria that automatically disqualify a company as a potential investment. This list is personal, but it should be based on the common causes of business failure. Your checklist might include items like a balance sheet with more debt than equity, a history of inconsistent or negative cash flows, a business model that is heavily reliant on a single customer or supplier, a company operating in an industry with fierce, undifferentiated competition, management with a history of questionable integrity or excessive self-enrichment, and, most importantly, a business whose products or services you do not fundamentally understand. This is a crucial element for entrepreneurs and CEOs to consider when evaluating potential acquisitions or partnerships. First, identify the deal breakers. The second step is to apply this checklist ruthlessly as the very first screen for any investment idea you encounter. Before you read a single analyst report, before you get excited about the growth story, you run the company's financials and business model through your failure checklist. Does it have too much debt? Check. It goes in the too hard pile. Do you truly understand how it makes money? No? Too hard pile. Is the CEO currently under federal investigation? Too hard pile. The goal is to eliminate 95% of all potential investments quickly and efficiently, so you can focus your limited time and analytical energy on the small handful of high-quality opportunities that remain. This process fundamentally changes your mindset. You are no longer a treasure hunter searching for a needle in a haystack. You are a quality control inspector, tasked with identifying and discarding flawed products from the assembly line. This discipline of saying no is the most underrated but most important skill in achieving long-term investment success and superior portfolio growth. The antithesis of this disciplined approach is the story investor. This individual's portfolio is not a collection of carefully selected ownership stakes in durable businesses. It's a scrapbook of exciting narratives and speculative bets. They are the quintessential amateur, guided by impulse and emotion rather than by analysis and a coherent investment strategy. Their decision to buy is often triggered by a flimsy catalyst. They might buy a cryptocurrency because a celebrity CEO mentioned it in a tweet. They might invest in an electric vehicle startup with no factory and no revenue because they read a flashy article in a tech magazine calling it the next Tesla. They get a hot tip on a penny stock from their brother-in-law and invest their savings without spending even 10 minutes reading the company's financial statements. The story investor is a perennial victim of the narrative fallacy. They are captivated by the potential of a revolutionary technology or a charismatic founder, and this excitement completely blinds them to the cold, hard realities of the business. They don't know what a company's profit margin is, what its return on equity is, or how much debt it has. They only know the story. They chase momentum, buying stocks that have already gone up dramatically and are invariably the last ones to the party. When the narrative inevitably changes, when the growth story falters or the technology fails to deliver on its promises, the stock price collapses, and the story investor is left holding the bag, confused and betrayed. They then move on to the next exciting story, the next hot tip, destined to repeat the same costly mistakes over and over again. Their path is one of constant churn, high hopes, and crushing disappointments. It is the direct result of focusing on the potential for brilliance, while completely ignoring the high probability of stupidity. The financial connection between this inverted stock-picking method and your bottom line is profound and direct. The most immediate impact is the avoidance of zeros. A single stock in your portfolio going bankrupt and its value dropping to zero can inflict devastating damage, particularly if you have a concentrated portfolio. A $10,000 investment that goes to zero requires another $10,000 investment to double just for you to get back to even. It is a massive anchor on your overall portfolio growth. By systematically filtering out companies with the common characteristics of failure, like excessive debt or a lack of profits, you dramatically reduce the probability of having a zero in your portfolio. This simple act of risk management is one of the most effective ways to improve your long-term returns. Furthermore, this approach naturally guides you toward higher quality businesses. Companies that pass through your rigorous failure checklist are, by definition, more likely to have strong balance sheets, consistent profitability, and durable competitive advantages. Investing in these types of businesses has a twofold benefit. First, they tend to be more resilient during economic downturns, meaning your portfolio will likely experience smaller drawdowns during market panics. Second, high-quality businesses are the ones that are able to compound their intrinsic value over long periods of time. They are the engines of true wealth creation. By focusing on what not to buy, you are indirectly but systematically forced to focus your capital on the very best businesses the market has to offer. This philosophy is the cornerstone of any serious long-term investing plan. It shifts your focus from speculating on stock prices to investing in the long-term success of excellent companies. This is how you move from being a gambler in the market casino to being a part owner of the world's most productive assets, a shift that is essential for building lasting, generational wealth. This leads us to our fourth pillar of inversion, a principle that may be the most counterintuitive and difficult to practice in our modern hyperactive world, the power of strategic inaction. Our culture is obsessed with action, with hustle, with being busy. We are taught that to be successful we must always be doing something. This bias for action bleeds directly into investing. Investors feel like they need to be constantly tinkering with their portfolios, reacting to news, and making trades to justify their involvement. The common question is, what should I be doing with my money today? This leads to a flurry of activity, buying, selling, rebalancing, that often does more harm than good. Inversion challenges this fundamental assumption. It asks, what unnecessary actions could I take today that would be detrimental to my long-term results? The surprising answer, more often than not, is almost anything. The greatest investment strategy is often to find a wonderful business and then sit on your hands for decades. Warren Buffett has famously used the analogy of a 20-slot punch card to illustrate this point. He tells students to imagine that when they graduate, they are given a punch card with only 20 punches on it. Every time they make an investment decision in their entire lifetime, they have to punch one of those slots. Once the 20 punches are used up, they can't make any more investments. This mental model is a powerful form of inversion. Instead of asking, "What's the next trade?" it forces you to ask, "Is this investment idea so compellingly wonderful, so overwhelmingly likely to succeed, that I am willing to commit one of my precious non-replaceable lifetime decision slots to it?" This framework immediately raises the bar for taking action. It forces extreme selectivity and a truly long-term mindset. It makes you realize that 99% of the opportunities that come across your desk are not worthy of a punch. This philosophy is not just a theoretical concept for Buffett, it is the core of his actual practice. Look at Berkshire Hathaway's largest holdings. He first bought a major stake in American Express in the 1960s after the salad oil scandal crushed its stock price. He has held it for over half a century. He first invested in Coca-Cola in 1988, after the market crash of 1987 made its stock incredibly cheap. He has held it for over 30 years, collecting billions in dividends along the way. His greatest financial successes have not come from a flurry of brilliant trades, but from a handful of great decisions followed by decades of patient, disciplined inaction. He bought the right companies at the right prices and then let the power of compounding do the heavy lifting. He avoided the stupidity of selling a wonderful business just to lock in a gain or because he was bored. His genius lies not just in what he bought, but in all the things he didn't do for the subsequent decades. The psychological force that makes this strategic inaction so difficult is our powerful, innate action bias. In the face of uncertainty or ambiguity, human beings feel a deep-seated need to do something. This instinct likely evolved for good reasons. If our ancestors heard a rustle in the grass, it was far safer to take the action of running away than to do nothing and analyze the situation. In the ancestral environment, inaction could lead to death. In the modern investment environment, however, it is often impulsive action that leads to financial death. When the market is volatile and our portfolio is down, the urge to do something, to sell, to change our strategy, to reallocate, can be overwhelming. Doing nothing feels like neglect, like we are not in control. We mistake activity for progress and equate trading with managing our money. The entire financial industry is built to exploit this bias. Brokerage firms, financial news networks, and market commentators all have a vested interest in encouraging activity. More trading means more commissions for brokers. More drama and volatility mean more eyeballs for the news channels. The constant stream of breaking news and market-moving data is designed to create a sense of urgency, to make you feel like you need to react right now. Inversion provides the mental shield to resist this manipulation. By asking, "What stupid action might this news prompt me to take?" you create a crucial psychological distance between the stimulus, the news, and your response. You recognize that the vast majority of daily financial news is just noise, designed to provoke an emotional, action-oriented response that is likely to be detrimental to your long-term goals. Practicing inaction is an act of rebellion against both your own internal wiring and an industry that profits from your impulses. It is the decision to play a long-term game on a field where everyone else is playing a short-term one. Creating a practical blueprint for strategic inaction requires building deliberate friction into your decision-making process. The goal is to make it harder, not easier, to act on impulse. The first step is to schedule your decisions. Instead of checking your portfolio daily or weekly, which only serves to expose you to meaningless volatility and tempt you into action, commit to a formal portfolio review only once per quarter, or even once a year. This is the only time you allow yourself to even consider making a change. This enforced idleness starves your action bias of the stimulus it craves and helps you maintain a long-term perspective. The second step is to implement a mandatory cooling-off period for any potential transaction. If you feel a powerful urge to buy a new stock or sell an existing one, you create a hard and fast rule that you must wait at least 72 hours before executing the trade. During this time, you are required to write down in detail the rational business-based reasons for the decision. Why are you buying this company? What is its competitive advantage? What is a reasonable estimate of its intrinsic value? Why are you selling? Has the long-term earning power of the business fundamentally deteriorated, or are you just reacting to a scary headline? More often than not, after 3 days have passed and the initial emotional heat has dissipated, you will find that the urge to act has vanished, and your written rationale looks flimsy and unconvincing. A third powerful technique is to make the costs of your activity painfully visible. At the end of each year, go through your brokerage statements and calculate the total amount you spent on commissions, fees, and, most importantly, the taxes you paid on any short-term capital gains. Give this number a name, your hyperactivity tax. Seeing the concrete 4- or 5-figure sum that you paid for the privilege of churning your own account is a powerful behavioral corrective. It transforms the abstract concept of frictional costs into a real, tangible loss that you could have avoided by simply doing nothing. This is the practical application of a CEO mindset to your personal finances, measuring and optimizing for what truly matters, which is after-tax returns, not the thrill of the trade. The polar opposite of the strategic, inactive investor is the day trader, the ultimate embodiment of the path of the 99%. This individual believes that they can beat the market not by owning great businesses, but by skillfully navigating the minute-to-minute or even second-to-second price flickers of financial assets. Their office is a multi-monitor setup displaying a bewildering array of charts, news feeds, and order books. Their life is a high-stress, caffeine-fueled race against algorithms and high-frequency trading firms. They are not investing, they are gambling on noise. The day trader is a pure servant of their action bias. They believe that every moment of inaction is a missed opportunity. They make dozens, sometimes hundreds, of trades a day, trying to scalp tiny profits from meaningless volatility. They are obsessed with finding the perfect setup, the magical chart pattern that will predict the next micro-movement. This path is not only extraordinarily stressful, but it is also a statistically proven road to financial ruin. Academic studies on the performance of day traders are universally grim. The vast majority, upwards of 95% in some studies, lose money. They are destroyed by the brutal combination of transaction costs and the market's inherent randomness. Every trade they make incurs a commission and a bid-ask spread, a small but guaranteed loss that acts as a constant headwind against their performance. They are playing a game with a negative expected return before they even make a single correct prediction. Furthermore, any gains they do manage to eke out are taxed at the highest possible short-term rates, meaning the government becomes their senior partner in any success. The day trader is the ultimate cautionary tale. They have taken the human impulse for action to its logical extreme, creating a strategy that maximizes costs, maximizes taxes, maximizes stress, and almost guarantees long-term failure. They are the perfect example of how doing more, in the world of investing, almost always leads to having less. The financial connection between embracing strategic inaction and building wealth is one of the most powerful and direct in all of personal finance. The most obvious impact is the dramatic reduction of frictional costs. For the hyperactive trader, commissions and fees can eat away 1 to 2% of their total capital every single year. That may not sound like much, but over a 30-year investment horizon, that seemingly small annual drag can consume nearly half of your potential final wealth due to the reverse power of compounding. By adopting a low-turnover long-term investing strategy, you effectively eliminate this headwind, allowing your entire capital base to compound for your benefit, not your broker's. Even more significant is the impact on taxes. This is a concept that many beginner investors fail to grasp, but it is absolutely critical for long-term portfolio growth. The difference between short-term and long-term capital gains tax rates is enormous. By simply extending your holding period on a winning investment from 364 days to 366 days, you can see your tax bill on that gain drop by as much as half, depending on your income bracket. Think about the power of that. By doing absolutely nothing for 2 extra days, you can increase your after-tax return by a massive margin. A long-term, low-turnover strategy is, by its very nature, a highly tax-efficient strategy. It allows your investments to grow in a tax-deferred state for years or even decades. This tax alpha is a free, guaranteed boost to your returns that you can only capture through patient inaction. When you combine the savings from lower costs with the savings from lower taxes, the financial advantage of a do-nothing approach becomes undeniable. It is a quieter, less exciting path, but it is the one that leads to the greatest accumulation of real, after-tax wealth over time, which is the only metric that truly matters in achieving financial freedom. We arrive now at our 5th and final pillar of inversion, a principle uniquely tailored to the challenges of our modern age, the inversion of information consumption. We live in an era of unprecedented information overload. We are constantly bombarded by a fire hose of financial news, market data, expert opinions, and social media chatter. The common intuitive response to this deluge is to try to drink from the fire hose. Investors feel they need to stay constantly informed, that the key to an edge is to consume more data faster than anyone else. They ask, how can I possibly keep up with all this information? This approach is a recipe for anxiety, confusion, and poor decision-making. The inversion-minded investor flips the question. They do not ask how to consume more. They ask, what information sources, formats, and topics are specifically designed to provoke emotional, short-term, and irrational decisions, and how can I build a system to ruthlessly filter them out? The goal is not to win by knowing more, but to win by ignoring more. Warren Buffett is the ultimate exemplar of this inverted information diet. His office in Omaha is famously sparse. There is no Bloomberg terminal, no bank of monitors flashing stock quotes, no television tuned to CNBC. He has said on many occasions that if he had a stock ticker in his office, he would be poorer, not richer. His approach to information is a deliberate and systematic rejection of the modern financial media ecosystem. He is not trying to keep up with the second-by-second noise of the market. He is trying to understand the long-term, fundamental reality of businesses. So what does he consume? He spends 5 to 6 hours a day reading. But he is not reading today's headlines or the latest analyst reports. He is reading annual reports and 10K filings, primary source documents that detail the actual performance and strategy of a business. He reads industry trade journals to understand the competitive landscape of the businesses he owns. He reads books, particularly biographies and histories, to better understand human nature and the broad patterns of business and economic cycles. His process is an active inversion of the typical investor's habits. He has identified the information sources that are most likely to lead to bad decisions, the ones that focus on short-term price movements, sensational headlines, and bold predictions, and he has eliminated them from his life. He is not asking, how do I get the latest information? He is asking, what information is timeless? What will still be relevant and useful in 5, 10, or 20 years? The answer is a deep understanding of business fundamentals, accounting, and human psychology, not knowing whether the market is up or down on a given Tuesday. By carefully curating his information inputs, he protects his greatest asset, his ability to think rationally and independently, free from the emotional contagion of the market's daily mood swings. He is not just filtering information, he is building a fortress around his own mind. The psychological principle that makes this information diet so critical is known as the availability heuristic. This is our mental shortcut of judging the likelihood of an event based on how easily examples of it come to mind. The media, especially financial media, is a master at exploiting this heuristic. A scary headline about a potential market crash, accompanied by dramatic graphics and an ominous soundtrack, is incredibly salient and emotionally charged. It becomes easily available in our minds. As a result, we dramatically overestimate the probability of a crash and are tempted to sell our holdings. Conversely, the slow, boring, but incredibly important information found in the footnotes of an annual report is not salient. It does not trigger an emotional response, and it is not easily available to our minds. As a result, we underweight its importance. The financial media's business model is to sell advertising, and they do that by capturing our attention. The best way to capture our attention is to appeal to our most primal emotions, fear and greed. Therefore, the information they choose to highlight is almost guaranteed to be the information that is most likely to push our emotional buttons and lead us to make impulsive, ill-advised decisions. An information junkie believes they are becoming more knowledgeable. In reality, they are simply making themselves more susceptible to the psychological manipulation of the news cycle. They are drowning in a sea of low-quality data and starving for a single drop of high-quality wisdom. To build your own practical blueprint for an inverted information diet, you must become a ruthless editor of your own attention. The first step is to conduct an information audit. For 1 week, keep a log of every single source from which you consume financial information. This includes television channels, websites, social media accounts you follow, newsletters you subscribe to, podcasts you listen to, and even the people you talk to about the market. Be brutally honest and comprehensive. The second step is to apply a simple but powerful filter to this list. For each source, ask yourself this question. Does this source primarily focus on things that will still matter in 10 years, or things that will be forgotten in 10 minutes? Information that will matter in 10 years includes things like a company's long-term strategy, its return on invested capital, the strength of its brand, and changes in its competitive landscape. Information that will be forgotten in 10 minutes includes today's stock price movement, the latest inflation reading, an analyst's price target upgrade, and rumors about a new product release. The third and most difficult step is the purge. You must systematically unsubscribe from, unfollow, and block every single source on your list that falls into the 10 minutes category. This will feel uncomfortable. You will experience a kind of information FOMO, a fear that you are missing out on something important. But this is a necessary amputation to save the patient. You must then consciously replace the time you were spending on those low-quality sources with a small number of high-quality 10-year sources. Commit to reading one company annual report per week. Subscribe to the shareholder letters of great investors like Warren Buffett or Mark Leonard. Replace the time spent scrolling through stock market Twitter with reading a biography of a successful business builder. This process is not about consuming less information. It's about shifting your consumption from a high-volume, low-nutrition diet of information candy to a low-volume, high-nutrition diet of information protein. This is how you build true knowledge and insulate yourself from the noise that derails the 99%. The antithesis to this deliberate, focused approach is the information junkie. This is the investor who confuses the quantity of data they consume with the quality of their decision-making. Their browser has 20 tabs open at all times, one for real-time quotes, one for a financial news aggregator, several for different market blogs, and a handful for social media feeds dedicated to trading. Their phone buzzes constantly with push notifications. A stock they follow is up 3%. A new economic data point has been released. A Federal Reserve governor is about to give a speech. They subscribe to multiple expensive newsletters, each promising a secret formula or a hidden edge. They believe that by immersing themselves in this 24/7 stream of information, they are gaining an advantage. In reality, they are suffering from a classic case of analysis paralysis. They are so overwhelmed by contradictory signals and expert opinions that they are incapable of forming their own independent judgment. Their decision-making becomes chaotic and reactive. They might buy a stock in the morning because they read a bullish analyst report, only to sell it in the afternoon because a scary headline crossed their screen. They are constantly second-guessing themselves, a ship without a rudder, tossed about by the endless waves of market noise. The information junkie is a tragic figure. They are working incredibly hard, dedicating hours every day to research, but all this effort only serves to make their investment results worse. They have mistaken the fire hose for a source of nourishment and are, in effect, drowning in the very information they believe will save them. The direct financial connection of adopting an inverted information diet is that it serves as the ultimate behavioral shield, protecting your carefully constructed investment strategy from being sabotaged by your own emotional reactions. Bad information is the direct cause of bad decisions, and bad decisions are the direct cause of poor financial outcomes. When you are consuming a constant stream of sensationalist news, you are far more likely to engage in the very behaviors we have already identified as destructive. You will be tempted to time the market, to chase hot stocks based on exciting narratives, and to trade hyperactivity in response to meaningless news. Your information diet directly determines your investment behavior. By filtering out the noise, you create the calm, quiet mental space necessary for rational, long-term thinking. You are no longer reacting to the market's daily whims. Instead, you are able to focus on the small number of variables that actually drive long-term business value. This leads to a more stable, consistent application of your investment strategy. You will trade less, reducing your costs and taxes. You will be less prone to panic selling during downturns, preserving your capital. You will be better able to hold on to your winning investments for the long term, allowing them to compound to their full potential. In essence, a properly inverted information diet is the final, crucial link in the chain. It ensures that your well-reasoned plans, your not-to-do lists, and your systematic approaches are not derailed at the last moment by a jolt of fear or greed delivered through your screen. For any entrepreneur or executive, this principle of signal over noise is the key to effective leadership and strategic decision-making. For the investor, it is the key to protecting your portfolio from its single greatest threat: the impulsive, emotionally driven, and poorly informed decisions of the person staring back at you in the mirror. You have made it to the end of this journey, and that in itself is a powerful signal. You have invested your most valuable asset, your time, into acquiring a mental tool that the vast majority of market participants will never discover. You now possess the blueprint for inversion, the backward-thinking secret that allows you to sidestep the psychological traps and common errors that guarantee failure for so many. You understand that the path to wealth is not about chasing moments of fleeting brilliance, but about the relentless, systematic avoidance of stupidity. You now know how to build a fortress around your capital, defending it from the destructive impulses of market timing, the siren song of hot stocks, the bias for hyperactivity, and the overwhelming noise of the information age. This is no longer just a theory, it is a permanent part of your intellectual arsenal. But it is crucial to understand that this powerful model, the principle of inversion, is just one component of a much larger interconnected system of thinking. The minds of Buffett and Munger operate on a complete latticework of mental models, each one supporting and amplifying the others. Inversion is the shield that protects you from catastrophic error, but what about the sword? What are the models they use to identify the truly exceptional businesses worthy of a spot on that 20-slot punch card? You have mastered the art of avoiding the bad, but there is another world of knowledge dedicated to finding the good. The video that is now appearing on your screen is not a random suggestion, it is the next piece of the map. It is the link that connects the defensive strategy of inversion to the offensive strategy of opportunity recognition. It illuminates another, equally critical mental model from this latticework, explaining how to move beyond simply avoiding the losers and begin to systematically identify the durable long-term winners. You have built the foundation by learning what not to do. The next logical step, the next piece of your mental arsenal, is waiting for you. For those who are merely curious, this is where the journey ends. But for those of you who are serious about completing your education, who are committed to not just surviving in the market but dominating it, the choice is clear. The click you are about to make is not just to watch another video. It is a declaration that you are ready to continue your ascent. Complete the latticework. Click and master the next principle.